You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to diversify in real estate by equipping you with tools hacked to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. Hey guys, welcome to an in-studio episode of the Reinvest Podcast. Really excited to be here. It's been a while since we've been in the studio.
That's what I was going to say. Person. Yeah, no, it's been a while, but it's good. I don't know if we've been in studio since we've moved to our studio here.
I think one of the cool things about being able to do in-studio stuff with Andrew, who we will introduce in just a minute, is it means that we have local and regional players that are big hitters to bring onto the podcast. And I think it shows a lot of the depth that's in our own backyard in the real estate investing scene. So very excited to get into today's episode and talk about capturing this overlooked segment of the industrial real estate market. So without further ado, I'm going to pass the ball to you, Andrew. Give us a little introduction. Who are you? And what company are you with?
I'm Andrew Hanna. I'm with Flex Real Estate. I've been in industrial real estate for about 5 years so far. So started out of UC at Phillips Edison, where I focused on acquiring grocery-anchored shopping centers with that group. It's a REIT down in Cincinnati. And then I worked with a private equity company called Viking Partners for about 6 years, where we acquired everything from hotel to multifamily to even industrial, office, every property type. And that was around $850 million worth of transactions all across the country. So got to see a lot of different things, look at different markets. But ultimately, I came back to focusing mainly on Ohio with Flex Real Estate. Flex Real Estate was founded to essentially expand the portfolio of properties that Nick Kennedy had owned. He owns Flex Machine Tools and Airtow Trailers.
Which is Wapak based.
Wapak based, yeah. And those companies, they owned real estate smartly, and he saw an opportunity to bring me on to help expand that portfolio. And since then, we've done 3 deals with outside investors buying about $15 million worth of real estate so far in the first 18 months.
Wow.
Our focus is under 100,000 square feet. So we're focused on Class B and A, industrial, and flex. That is under 100,000 square feet. And locally, so up and down 75 and in
So
Columbus.
Let's back up just a little bit. So what was the first company that you said you were with?
Phillips Edison.
Okay. How did you get connected with them? What made you want to get into the real estate space? You said, what was your college education in?
I actually was in finance and real estate in college. So
so you knew from college that you wanted to be in real estate.
Yeah, so I interned with Phillips Edison for 2 years before I started full-time there. Did everything, started in accounting. That was not my favorite. Tax accounting, it's important now, but I don't necessarily need to use that skill all the time or want to do it full time. But
Was it not like, did you not like the fact that it just wasn't forward facing? Or
pretty much, yeah. I always say that we get to have more fun with numbers on the finance side. We get to think about optimistic things, not so much just keeping the books. But those people are incredibly important, the people that keep it well put together. We have our accountants to keep the consistency, but I'm looking forward and saying, here's what we can make of this property. So I really like that. So always focused on getting to the acquisition side of things.
So most people coming out of high school don't have this burning desire for real estate. So what was it in that period where you, looking forward in college, you were like, I think maybe this real estate thing could be something?
Through my fraternity, I had a couple friends that were in the real estate association. UC, University of Cincinnati's real estate association is fantastic. Like it's one of the best regionally. You think of good colleges that people go to for commercial real estate. You think of like Wisconsin, and you should think of Cincinnati in that same vein. Like they bring in professionals, and it was the ability to go get invited. My friends had brought me over and said, hey, come check this out. And I was able to see professionals, what they did. Originally, I wanted to be a broker. It looked fun. Those people are always having fun at happy hours, always doing different meetings. But
it's not the glamorous life you think.
Eventually, I did want to come to the landlord side. I did my internships with Phillips Edison, did transactions, so due diligence of buying shopping centers. And then I went to leasing, liked leasing a lot. And then I did acquisitions, and I was like, this is it. Like, I want to acquire shopping centers. I want to put together this business plan. And that's the fun part. It's putting together the business plan and looking at the markets and seeing what's right. I will say shopping centers are far more complicated to operate than industrial.
Oh, right. I'm sure.
A lot of national tenants, a lot of CAM reconciliations.
Oh, yeah.
Yeah.
You know, it was funny. I was in our coaching. We're doing some real estate coaching on the commercial side. And one of the seasoned brokers that was doing the Zoom meeting we were on was talking about his inroad to get leads would be on a tenant rep side to reach out to them in January and say, hey, I will help you figure out if the CAM reconciliation that you're at, having to pay or come up with more money is actually correct. And it would kind of earn this audience with them of like, if you're being raked over the coals by your landlord, I'll help you move. So it was on the other end of that equation.
Yeah.
But, that was a tactic for him to kind of step in to that whole, debacle.
Pretty
there.
sneaky.
It is pretty sneaky.
Well, the other thing is like these large national tenants too, like TJ Maxx, they're huge. They have multiple different flags, and they have whole departments working every day to dispute the CAM rec. So as a landlord, you have a lot of work to make sure it was right.
Geez.
And also when we were buying shopping centers, I was the one that was tasked with rebuilding. So I learned a lot about building a CAM rec, and how to do them.
Because you're essentially auditing stuff every year.
Pretty much. Yeah. And their leases are so finely written that it's like certain types of insurance we won't reimburse.
Wow.
I'm sure on the multifamily side, you're not so worried. It's more like electric and water.
Right. Yeah. It's like there's a common hallway here that we got to account for.
They're like, no, we won't reimburse for fire, but maybe liability, and then only if it hasn't increased by 5%.
Wow.
Yeah.
So was there like when you were working there in the company, was there kind of a cheat sheet for different national tenants on how their leases were traditionally structured?
It's just more of a learning experience. It's grocery. They have the power. Like, that's who you want in your center. You want grocery in these junior boxes.
Because they bring the foot track.
Yeah, exactly. And the B shops are where you make your rents. That's the rents that are $20 to $30 a foot versus the grocery that's you're barely breaking even on them. There.
Gotcha.
But that's the value.
So getting such a broad range of experience at Phillips Edison and then at Viking Partners, where you guys went on and for you stepped into different asset classes that you hadn't when you were at Phillips Edison. What did that broad exposure of commercial real estate from a corporate perspective do for you?
From a corporate perspective.
Because, I mean, when we think about, like you'd mentioned bigger pockets off camera, it is a lot of like peer-to-peer investment kind of entry level, but you're stepping in at firms that are private investment, private equity, transaction size higher on a dollar perspective. You're probably looking at 10 million would be the lowest deal that you guys would probably do, right?
Yeah.
There's a level of sophistication that is just expected to compete for those kind of deals.
Something is like that I bring to the table is that, but that's my whole worldview. So the bigger pockets arena, the smaller peer-to-peer investing you're mentioning, that's actually new to me because it's more like single family homes, the Burr method, things like that. Right. Like I'm getting used to like hearing more about that.
Right.
But what I'm bringing to our investors and our company is the commercial side. So I actually like don't have the perspective when people talk about investing in single family homes. I get it, and duplexes, things like that.
Right.
But it's not my main focus. Never.
You're
has
like
been.
I understand that you're trying to get a lease signed for $1,000, but I'm negotiating $1 million lease right now. So it's just a little different.
No, I think there's so many different ways to make money and be successful in real estate.
No, that's one of the great things about it.
It's a wide diversity. Yep. And me, what I'm bringing is I know how to quarterback those people a little bit better, maybe. I know the firms that we need to see. I know the lawyers that we need to get. So being the quarterback on an acquisition, a business plan, like you have a meeting, you have a property manager there that they don't work for your company. You have a leasing agent, they don't work for your company. So you have to learn how to work with a lot of different players and
align those interests.
Align those interests because a lot of people don't know what they should be paying.
Right.
What should I be paying an environmental investigator, engineer? What should I be paying a leasing broker?
And how do I go through a due diligence process and gather as much information as possible and not spend money before I have to?
Exactly.
Like there is such an art to courting that process and being competitive, moving forward things in a timely manner. And what I've realized, and things are becoming more, I think, public in terms of the process of some of this stuff, but in the commercial space, I was even on this coaching call, and somebody on the call was like, hey, where's like the cheat sheet? Where's like the formula for how I do this on how to get in front of the right types of people? And the guy was like, yes. Like there isn't one. You have to learn it. You have to refine that process, which is part of the fun of building a business like that. Is you guys are now at Flex Real Estate refining that process, bringing your skill set in. One comment on Flex Real Estate, and then we can jump into where you guys are at now and kind of your mission or your focus from an investment perspective. I love the fact that Nick solved his own problem, but had vision beyond where most business owners stop.
Yeah.
So like if you're a business owner and you grow a business, you will inevitably own commercial real estate because it's vertically integrated in your company and it's a necessity. It's a byproduct of a growing business. But he didn't just stop there. He looked beyond that and said, wait a minute, I think that we can manage the own portfolio that we're creating, the market that we're creating. And then actually there's like a profit center here that we could build on outside of where we're going to expand as a company. And that just takes a vision, because a lot of guys would stop at that and say, we don't want to do that. You know, I don't want to build a company, because really you can't treat it as a hobby. If something's going to be successful, it has to be a business.
Yeah.
So he went out and found people who are qualified for this and built a whole company around it.
I mean, yeah, we had a meeting this morning where we're talking about this. We're saying like, hey, we built a platform that we're ready to seize on these opportunities, because I'm sure there's so many opportunities around here locally that people don't know what to do with them, nor do they have the perspective long term to think about, oh, what's the cap rate of this going to be on the exit, or how can I value this? How can I be in the right position to value it? It's more so as an operator, you're thinking on your ROI in terms of that rent.
Right.
We're sitting there thinking about the real estate as an investment. There's a limited number of people doing that around here. And nationally, there's probably not as much focus, but up and down I-75 is a great market. There's not much competition in terms of new building, and it's solid, steady. A lot of fabricators, a lot of manufacturers.
Let's jump to kind of where you're at today in Flex Real Estate. So, I mean, you had mentioned briefly earlier, you guys are looking for properties that are 100,000 square foot and less for industrial or flex space. Why? Like, why are you not targeting anything bigger? Or is there just not much volume past 100,000 square feet?
Well, the real thing is there's a lack of development. So it's very expensive to build industrial real estate under 100,000 square feet. The economies of scale are not there. Around here, it's probably you have to get like an $8 to $9 per square foot triple net to build a 50,000 square foot building.
Gotcha.
And there's not people willing to take that risk. There's a few outliers that are starting to build, but the rents don't justify it yet. And we can capitalize on the mark to market of unsophisticated investors and the rents they've set, where they've said, oh, it's been a few years, 10 years, we'll bump you up by 25 cents. The rents are still
extremely
at
low.
$2 modified gross. They're not getting recoveries for real estate taxes. And there's just opportunity there to professionalize a lot of real estate around this area.
I think in my conversations with owners of properties like what we're talking about, in a single tenant scenario, there's a fear that if a lease renewal is coming up, I might negotiate so hard that I would lose a tenant. And in that scenario, you're talking about 100% occupancy to 0%. And that might feel intimidating for somebody who is a mom and pop owner who wouldn't know then how to keep that together or to pivot and fill a vacancy like that. But you guys obviously have a different comfort level in that negotiation.
Yeah. Well, I mean,
where does that confidence come from? Do you know you're confident you can fill it again, or?
It's the platform. We have a property manager. We have me. I know lease rates generally, and we can have a local network. We have the legal team to do it. Downtime is absolutely the enemy of everyone. Right. It's bad. You don't want to be paying taxes on something or paying a mortgage while you're not getting rent. But the market currently, as it sits, and you have to constantly reevaluate the market, it's hard for people to move around here.
Yeah.
It really is. And then you have to evaluate your tenant and say, all right, like they've put in these massive presses. How expensive is it to move that machinery? If you're a manufacturer, it's very expensive. Is this next landlord going to let me cut out part of the floor? Will this space work for me? So you have a lot of power in that situation. I think you can do things fairly. You can make those increases fair, make them amicable, and you don't want to negotiate so hard that they distrust you. But we don't fear it so much because we are always generally getting a sense in the market and talking to operators, and we are an operator.
Right.
Right.
We're owner
That's
occupied.
a good point.
Yeah. And to your point, Garrett, we've seen around here, I mean, there's a lot of mom and pop owners or people that were owner operators for a while, and now they've just been renting it out. Maybe they've retired from their business. And their leases, we get in these situations where their leases are just crazy bad. They favor the tenant in like every which direction. And so when it comes to lease renewal time, they have no leverage because their leases are so poor. And so I guess for anybody listening, get professional help on your leases. Don't just have a regular attorney or don't draft your own lease for these industrial or commercial spaces. We were looking at a lease on an industrial warehousing property, and it was like there was just a clause in there that it was like a 5-year lease, but at any moment the tenant could just give 30-day notice and leave and be released from it. Was like basically you have a month-to-month lease. You don't have a 5-year lease. It's not worth anything.
That's interesting. We talk about with our lawyer on our team, Courtney. She's our COO, Courtney Burton, and she talks about, is this lease financeable? She had gone to a conference for real estate.
That's a great question that people don't think
it's
about.
like, is this lease financeable? That's a scenario. And I always have to tell her, like, I think this is fine. Like, these options are fine. We're within, because we have really well-written leases, in my opinion. But she asked that question. That's a scenario where the bank's going to look at that and say, no way. And I'm not lending money on this.
Is it financeable, and is this lease saleable? Because that's where we come in. We're like, you can't even market this as like an investment because at any moment this tenant could leave. And so, super, super smart to dial in that. Yeah. So
give us a couple of case studies for some deals that you guys have done through Flex Real Estate. Maybe not having to get into the particulars of things that are confidential, but just how have you guys been able to put all these pieces together and find great deals for investors? And where have you uncovered value where others maybe didn't see any?
So one scenario that we did last November was we bought a building in Troy. It's about 45,000 square feet, 1996 build. Clear heights are like 24 feet. Really beautiful 2-tenant building. The owner wanted to retire, sell his assets. He wanted to move on. We were able to buy that building. And also, because of the manufacturing companies, we found value in also buying the assets of the manufacturing business. So we were able to get into the building for a very low
So he was basis. An owner-operator in that building.
Yeah, but it also had another tenant as well. So a 2-tenant building. So we were able to get into it for a very low basis. We now have a manufacturing company operating there in part of the space that they're helping out our manufacturing companies. So they make parts for it. So it's a sale leaseback that worked for both the manufacturing company and our investors. And that building is doing great. It's got a great return.
And you left the other tenant in place?
Yeah. They are through 2027. They're doing very well.
Most industrial leases are 3 years.
We see 3 to 5 years a lot. Okay. I think on single tenant buildings, you would see longer terms. I think we stick mainly to 5 years for multi-tenant because you still want that opportunity to reset the rent later. Yeah. You can do that through options too. We talk about lease terms. I'm not a fan of a fixed rate on a renewal because you don't know where the market's going to go.
Right.
That's good.
Do you guys usually build in increases? Now that we're on leases, sorry. Do you guys normally build in any increases like, hey, year 1, year 2, year 3?
Pretty much every year. Yeah. I'm looking for that. I'll set terms to be where like it's advantageous to have those lease increases in there. Around here, probably 2.5%, 3%. In Columbus, you're starting to see some 3.5% to 4% rental increases. I like percentages. I don't like whole dollars when we're talking about those as well.
Yeah.
A lot of people are a fan of a quarter a foot, but that starts to shrink as the dollar amount goes up.
Yeah.
And, becomes less of an increase. So,
one of the questions I wanted to maybe highlight for somebody listening to this that didn't know, you'll hear a sale leaseback. Mm-hmm. Explain to somebody listening to this episode, what is that in the industrial kind of sector?
So you have a business owner that owns the real estate as well. They have a company. The company is going to exist into the future. They're going to sell their building. They're going to separate that asset from their business. Typically, it's already held in a separate LLC if they're using smart planning. So they'll sell that building, and then we'll buy it, negotiate a lease with the existing tenant, whether they own the business or not. Some scenarios, they're selling the business as well, separately or together. A lot of the people have found value is actually higher in the real estate they own long term.
Yeah. We have a client right now that two partners owned their company together, owned the real estate, like you said, in a separate LLC. Kind of, you're paying rent to yourself, and there's some tax ramification to that that's positive. Sold their business, and now they have the real estate, to kind of solve as an issue. And when they had took this project on and acquired this building early on in their company, they had this as a part of their exit plan. We're going to have it paid off, and we'll be in a position then to sell the real estate, and had their projections of where they would be on an appreciation perspective. I had a deal come across my email probably 3 weeks ago, and it was this same scenario. It was a company that was a pest control company in Florida, which is not super sexy, but they don't have to be. It's a service-based business model. They had expanded to like 7 or 8 locations through Central Florida. They sold the company, and now they were selling the real estate as an industrial portfolio to an investor base. So it's an interesting concept when you come across these scenarios, because that sale leaseback is an exit plan or a part of an exit strategy for an owner. And you guys have been able to capture that in some scenarios, both on the acquisition of the business and the real estate. Have you ever been just on the acquisition of the real estate in a sale leaseback scenario?
Yeah, actually here in Wapakoneta, we bought a building from Everyday Technologies down on 33, and we really like that building and think that tenant will stay in there long term because there's such a commitment to the equipment that's in there. So we're buying the building. We think they're going to be committed long term, but if they do vacate, if they ever did, we feel really good about the location. We can clean that building up, and it's very attractive. It's got access to 33. It's got a lot of visibility, and it's got some parking field too as well, so it'd be attractive to a user.
Is there ever factor into your guys' analysis of a property on the front end that maybe you're looking to acquire added land that could be expanded on? Is that usually a marketing tool from a broker that is never feasible, or are there legitimate scenarios where you would take on an expansion for a tenant that's doing really well?
I'd love to do that. That's the cherry on top. I absolutely, usually, I would say 99.9% of the time, I've not even once considered the extra land. It's my old company, Viking Partners. We look at that. I know exactly what you're talking about, and it's like, yeah, there's an acre of land. You can build on it. Like, it's great.
We heard the tenant's interested in expanding.
Yeah.
We have that exact scenario happening right now at one of the properties we have for sale, and
you're buying the building below replacement cost generally.
Right.
So if you start to replace, you brought up your basis, and it's
might a blended average. It's not as attractive.
Yeah. So it's nice to have land. You could sell it off potentially.
Yeah.
But no, I usually don't put it into my underwriting.
At the end of the day, you guys aren't interested in speculation.
Not yet. I think we will develop something. Will it be in Wapakoneta? We'll see. For the businesses, we would build. That's not going to be speculative, obviously.
Right.
But if we built out our team to be more geared towards development, it would be, Ohio's got a lot of great markets that you could do that in.
How would you look at a vacant 50,000 square foot building from an underwriting perspective? Would you price it on just like price per square foot. It's a vacant building. You're going to have to go do the legwork to find the tenant. In commercial real estate, the value fluctuates drastically. I don't know if you have any percentages to that of what you would pay for a vacant building to what you would pay for a building that has a tenant in place.
Yeah. So I look at the per square foot first. The basis is always going to save you in hard times. And then I say, all right, how do I have to capitalize this to spend 18 months leasing this up? That's a worst case scenario, obviously. But if I beat it, that's great. But I look at that and I'm like, how can I get to, for this risk, how can I get to a 20% IRR or a 2 equity multiple? Those are usually the two metrics I'm looking at.
In a 5-year period.
Pretty much, yes. If I get it leased up faster and we hit a much higher IRR and a higher equity multiple,
everyone's
that's great.
happy.
Yeah.
Here's an honest question. Do you ever have a hard time disconnecting your emotion from a property? Like, we one of the biggest dangers to any investor is emotion. But let's be honest, it's a struggle that we all have. It could be a passion project, a tenant that you really like their business model, or a property that you just think is phenomenal. Are you pretty good at being cold and disconnected and just diving into the numbers? Have you gotten emotionally attached to a property you had to kind of step away from?
I think that I've read enough, and like people say, like risk is the number one step. Like you should start by analyzing the risk, and I'm actually bad. I'm probably the least optimistic investor. So like I'm usually saying no on the front end.
So you don't think interest rates are going to go down?
Yeah, no, I'm saying no and then convincing myself I like the deal. And then when we're in due diligence, I'm like, do I like this deal?
Yeah.
Like I have to sit there and reevaluate it every time. So that's, I think, what keeps us safe in a very risky investment type. There is risk to real estate. It's great because you have downside protection. The building exists, the land exists, but you have to constantly be questioning like the risk of the investment. So I'm actually like probably as investment partners, me and Nick, he's much more the optimistic, the
bullish,
operator.
Let's get after.
I'm the one saying like
Andrew,
found
rework
this.
the numbers.
Run it again, make this happen.
But no, it's a good balance because you do need to be optimistic.
Right.
No one would ever invest in anything if you weren't optimistic and you couldn't put numbers behind it. You want the evidence there. And
one of the biggest risk factors is the tenant itself. So how do you know, just because the lease term says, hey, it's got legs left on the lease, we got another 2.5 years before renewal, there's, options for increases, we love the lease terms. Yeah, but what if this company is not going to be in business in 2.5 years? How do you guys vet the tenant?
Well, if you can get the financials, that's the number one thing. Not everyone is so willing to...
Balance sheet,
P&Ls. Not everyone's willing to share that, so you want to know that the company is profitable. So that's probably number one.
Because these aren't publicly traded companies that you're going to be able to get that information for.
Even if they were, honestly, if they were publicly traded, it would be harder to get that site's numbers because the publicly traded company would be less likely to share things about that site with you. That's a nice thing as business owners with Flex Machine Tools, Airtow trailers. We have an understanding of what those should look like. What should profitability look like for a manufacturing business? So if you're
have you had your tenants share that stuff with you?
Yeah.
Okay.
Absolutely. And sometimes you want that. If sell leaseback, especially, you would ask at a minimum.
Right. Are you selling because you have no other option, or are you selling?
Like, is this business going to exist within the space long term?
Right.
And if it's shaky, you have to make sure the basis allows for you to release that space. So you just have to buy it at a lower basis and like the box a lot. I think that being well diversified in the information you're taking in helps you evaluate. Because I don't sit around and think about real estate constantly. I like to think about like macro economy, read the Wall Street Journal this morning. What's going on? What's going to affect this industry type long term?
Yeah.
And around here, it's manufacturing. So it's just, you have to be in touch with what's going on with manufacturing, have a general understanding of what that business is doing, who their customers are, how they're making money, and then you can get more comfortable with the tenant, but always keep in mind basis is king.
Yeah. Is there a way to quote unquote credit check a business? I mean, you hear about like, this is a AAA rated company. Like, where are people going to find those kinds of evaluations? Are there like
Public sites?
Yeah, public sites out there that are like putting a score on a certain company. If they're registered with a Better Business Bureau, does that have like weight with you because you know that they're at least running with a certain level of ethic and professionalism? Or
there are certain sites, and we do run a credit check on one of them for tenants that I apologize, I do forget the name of the website, but it's very limited information.
Right.
You could really...
That's not the driving force of what you base your decision off of.
If you want to like really make sure that a tenant is in good standing, go to the legal websites, go to the recorder office and search and say like, search this business.
Are there pending lawsuits?
Yeah, are there pending lawsuits? Because that will like honestly downside risk. Like you have to think about what's going on with that tenant. So you should use as much public information as possible. Have they paid their real estate taxes if they own the building?
Mm-hmm.
That's a big one.
And that's pretty easy to check.
Yeah.
So,
all right.
Okay, we're gonna jump into our smaller pockets segment here. So, Andrew, go ahead and tell us about a deal that went wrong. So, what happened? What went wrong, and then what did you learn from it?
Yeah. So at my prior company, we invested in office buildings in Denver. It was with a joint venture partner, so someone that's far more optimistic than we are. They're driving the optimism. We're, making sure the risk is worth it. Class B office in Denver, Colorado has not done well. It's gone very poorly. You think that you acquired the buildings at
what year was this?
It was 2020, I believe.
Before COVID?
No, COVID was a thing. Okay. Like we knew that office was struggling slightly.
So you thought you were buying the discount already.
Yeah, and it just had not come out yet.
Wow.
But you just have to be, it taught me a lot about someone else's optimism. So we bought 400,000 square feet in one site and then 100,000 square feet in another. I think the 400,000 square foot site's doing well. I think the 100,000 square foot site is not doing so well, but it's taught me about measuring someone else's optimism a lot from a partner perspective. And then just that you want to be really sure that there's demand for your product type. I mean, you have to generally know that. And there was demand. There was leasing demand, but getting it over the finish line is hard. And then being on that capital treadmill of office, it's expensive to get people into your building. So it taught me a lot about that product type. I don't think office is dead, though. I think that it'll come back around. You just have to get it at the right basis. Lenders have to be willing to lend you money. Yeah. It was just a moment in time, and you have to constantly gut check these moments in time.
It was weird. I feel like at a macro level, lots of large companies either by necessity in response to COVID or because they saw a trend that they wanted to test, try the remote thing. And like, wait a minute, we don't have the infrastructure to actually manage people who are not physically in a certain location. And there was obviously, I think, an element of the workforce that never returned back, and there was a move in that direction, but we were not ready for that kind of like lack of accountability.
Yeah, no, it's different. It's coming back. There's a lot more people coming back to the office, but
I think people kind of want it too, though, because there's a human element that will never be replaced.
Well, and a lot of the big companies have already mandated people come back to work. I mean, Amazon, they pretty much just told everybody.
About your brother.
Well, yeah, he was a remote worker. I know a couple of remote workers from Amazon that it was just mandated. It was like, hey, you either voluntarily quit or you return to office. Yeah.
So I mean, you have like those 90 days to get here. And you have 90 days.
Yeah. Those are the types of things that these large companies started doing.
Yeah.
And obviously that was good for whoever owned those buildings. They were probably sweating there for a while. So
I think one of the things that goes overlooked if you've never stepped into the commercial sector truly is how the financing markets dictate supply and demand. Because to your point, if you go and bring an office financing opportunity to a lender, they're going to say pass. Because maybe they've made, or their loan committee's made a policy for the next year or however long, we're not going to take any more loans that are office related. And so you're really at the mercy of what banks are willing to finance and what they're bullish on and what they're conservative on. And then there has to be time for that to change sellers' expectations on pricing. And so you just don't want to be the buyer that steps into that market and you buy something overpriced. Yeah, that's interesting. So how do you, moving forward then with that lesson that you mentioned, measuring someone else's optimism, what are those checks and balances in place so that when Nick comes in or some unnamed person comes in with their optimism, you're like, I just want to make sure we're looking at this objectively.
No, it's just understanding the market, like comparing it to every property that's around it. Going back, seeing if you like the location, seeing if there's access, seeing if the tenant is actually as good as you think it is. It's just constantly rechecking evidence until you feel really good about what's happening there. And also allowing yourself to not like something and disappoint someone if you don't like something. I mean,
right. Yeah.
You were both brokers, real estate agents, correct?
Yeah.
Yeah.
You have to be a little optimistic. And I feel like I rain on parades more often than I don't, but it's like, it's hard. You just have to keep rechecking the math.
Yeah.
Yep. We're going to go into what we call our little nugget. So, Andrew, this is the part of our show where you give our listeners a practical takeaway, piece of advice, something fundamental to the way that you operate yourself that they can apply to their businesses.
So I honestly, it's kind of boring, but I would say read everything you can. There's
Nice.
so many good books out there now. I can even provide you with a few titles.
Yeah. What's a couple of your favorite recently, I guess?
We recently, me and my analyst read The Game, which it turned real estate into an analogy about a board game, but it truly does show the different players. It is that quarterbacking thing where there's so many different players and things affecting what's going to happen with your investment. You have only so much control. You have to control those variables, and you're dealt so many different cards by capital markets, by the market for that tenant, and by the scenario of the site, like whether there's an environmental issue, something like that. But this guy, he's an old Harvard professor, and he puts it in such a good...
Is it an older book?
It's a little bit older, but he does such a good job, and I've read so many real estate books that I was like really interested in what he had to say, because it is kind of repetitive after a while.
Right.
You read a few books and you're like, okay, this was the same set of things. There are good checklists that exist out there, but I just thought he had an interesting perspective about how the macro environment affects your micro investment. And how all of these different players can affect yours. And we were talking about risk. I mean, that's everything, knowing what's out there.
If you don't know how you're making money or being successful, it's a matter of when, not if, you encounter something that is going to be detrimental to your business. And I think that outlines like what are the fundamentals of how to continue to replicate a certain outcome. Because a lot of guys got lucky just because they bought in an up market.
Oh, yeah. I mean, like a lot of people think they're good at real estate investing because interest rate drops. So it's
they're
tough.
like, man, we got this figured out. We got it dialed in.
I think the fun thing about where I've worked is I got to experience a lot of different property types and like the players there. And I really like retail because you have smaller guys that think like, I'm crushing it. I've sold like all these In-N-Out burgers, like these triple net properties are doing great. But then you have the mall operator who's like, this is the worst ICSA conference we've been to. And I just love hearing about how their emotions change over time, because they're probably the most built out in terms of conferences and people getting together as a whole industry. And I love every time they go to an ICSE. They have this Vegas conference I've been to a couple times. I'll ask all of them, like, what's your perspective? Like, what are you seeing out there? And it just depends on who's coming back, who's sad, who's happy.
Right.
But I mean, when I was at Phillips Edison, there was a time where everyone was very happy, and then there was a lull, like 2018 to 2019. Grocery anchored shopping centers weren't doing as well. They're crushing it now. Like they continued to buy through it. They invested smartly. It's a great company, and they are doing very well. And those retail shopping centers are doing great. They're splitting out these strip centers, and that's been a very popular investment product. So they've found value long term from some of these centers that probably didn't exist in 2018. So it's constantly
Yeah.
changing, but it's fun to see like where people are at.
Yeah, it is funny. We were on the multifamily side, went to a couple conferences.
Yeah.
And it was like, man, like we're making so much money.
No, yeah,
You got
no,
these
so-
like vendor booths. People are popping out of the woodwork.
We went to the same conference in like 2021, 2, 3, and 4. And it was so funny. It was like 2021 and 2022. I mean, everybody's just psyched out of their mind. Everybody, huge conference. Everybody's coming.
be a part of our coaching like community where we'll fund you deals.
2023 though.
Bad.
It was
Bridge loans.
It was just everybody's depressed, and the theme of the conference, quite literally, was survive until 2025. That was the theme of the conference, and so it was so interesting. And then 2024 came around, and it was everybody's, hey, here's my rescue fund, my rescue debt fund, and it's all these syndicators. And we found out, we know of a couple companies that have done this. They developed
prominent names, yeah.
rescue funds,
I've seen it.
but to rescue their own deals.
Oh yeah, and it's
They don't advertise it
marketed
that way.
as like this is great. I'm thinking of a company I think is out of Arizona, but I've seen it on X.com. Like if you go into the real estate forum,
Yeah.
that world, which I do, like there's people that call those people out, and it's interesting to find out
No,
about.
there's some big companies that are
Yeah.
doing that right now.
There was a bingo card going around with icons of different companies, and they were like Xing out
The ones that went belly
and
up.
like which ones are next, you know?
Yeah.
So an interesting time. I think it speaks to the return to the fundamentals, right?
Yeah.
And it's good to be a syndication company right now. I think there had to be an investor shift, because when money was being freely distributed, 30% like brought into our monetary system was a historic precedent that a lot of us didn't have a concept for. People were kind of blindly throwing money places. And now the investor had to readjust their perspective of like, wait a minute, I don't just want to find a return or a pro forma that says they can get me X. I want to say, can you achieve this? Are you a trusted operator? And it's not as sexy. People are hitting singles and doubles because this is the market we're in.
Yeah, I think if you're an LP investor, it's doing your homework on who you're investing with. You want to be with successful business owners that have done it before. You want to be with real estate people that have done it before and are also on the grounds getting information constantly. Like for you guys, you're getting information constantly around multifamily around here. So you would trust something like that. If you see someone that is saying, oh, I'm like a nurse, I do high net worth for like just other medical doctors, like I have zero experience in real estate, I wouldn't necessarily go to that person. And there's a lot of multi-tiered partnerships that you don't, as an LP investor, understand that you're getting cut down on a waterfall 2 times already.
Yep. If you don't understand what a capital stack is and where you fall in that, you should not invest in a deal.
Exactly. So, joint ventures aren't bad.
Right.
But being misleading about where the joint venture is and being basically an online internet personality that just brings money from one place to a different operator, and you're splitting with them, who's splitting with the investor. Like you have to keep in mind, like it's a partnership. Like you want to succeed with your investors.
Yeah. That's good. That's a good way to kind of close this conversation. And so in closing this, how can people find out more about Flex Real Estate and follow your guys' success?
Yeah, you can follow us on LinkedIn. On Flex Real Estate is the name of the company. And then also I publish a newsletter once a month, and we will post the link to sign up for that as well.
Okay, sweet.
On LinkedIn?
Yeah.
Okay, cool.
Well, man, thank you so much. Again, really cool to get with somebody in our local market that's doing stuff in a big way outside of our market and in our backyard. Appreciate your time today.
Yeah, thanks so much for having me.
As always, excited that you joined us for another episode of the Reinvest Podcast. If you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, reinvestcapital.us, and shoot us a message. Move farther, reach higher, and grow deeper.